if they say gold is now 24,000 an ounce, the U.S. Treasury stands ready to buy any gold that central banks, maybe even they go far as saying individuals. I don't know how far they take it, but the mandate would be we will pay $24,000 an ounce for your gold. China is the largest producer of gold in the world, the second largest of silver in the world. All of the countries, it would behoove and benefit them to do exactly that, and to do so in a way that allows them to continue to add. It doesn't affect the price as they're buying it.
The gold market may be on the edge of a seismic shift, and Andy Schectman, CEO of Miles Franklin Precious Metals, believes the writing is already on the wall. With over 30 years of experience in the gold and silver industry, Schectman is presenting a scenario that most investors aren't even considering: the deliberate revaluation of gold by the U.S. Treasury to $24,000 per ounce. In such a move, the Treasury could offer to purchase gold at this fixed price, not just from central banks, but also potentially from private holders. The implications would be massive, a monetary reset hiding in plain sight. In this unfolding landscape, the imbalance between U.S. gold reserves and federal debt is impossible to ignore. Gold currently backs just 2% of outstanding government debt, a sharp contrast to the 40% coverage seen during World War II. If that ratio were restored, models suggest gold would need to be priced between $24,000 and $55,000 per ounce, depending on the level of debt coverage. The math is simple, but the consequences are anything but. Schectman warns that behind the scenes, a silent plan may already be in motion, one that sacrifices the dollar to maintain the integrity of the bond market. With $3 trillion annual deficits, $28 trillion in debt maturing by 2028, and only $15 trillion in projected tax revenue, the U.S. financial structure is no longer sustainable. The recent tax and spending bill passed on July 3rd is expected to add another $3 trillion to the deficit, pushing the country toward a slow-motion debt spiral that could ultimately erode the Federal Reserve's independence. In this video, we break down Andy Schectman's thesis, including the historical context behind gold revaluation, the alarming debt metrics facing the U.S. government, and the potential shockwave such a move could send through the global financial system. If you're serious about understanding the future of money, gold, and fiscal policy, don't forget to like this video, subscribe to the channel, and share it with others who need to hear this. We're just getting started.
I believe they're going to eviscerate the dollar. In fact, I believe the whole plan is to destroy the dollar in an effort to support the bond market. The indebtedness is beyond belief, and it's growing by the day. And in essence, when you add in the $3 trillion a year minimum budget deficit, along with the $28 trillion that is due in 2028, that's $37 trillion off of $15 trillion in tax revenue. We're a long ways away from just, paying what we owe. They have no choice. And this is why I've been talking a lot about stable coins that will be used to fund the front end of the Treasury market, and my belief is they will peg gold to the back end to have zero interest rates to reshore manufacturing. I've talked a lot about this lately, but all I do know is that something very, 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 very big is happening with gold. Do you realize that in the first 3 days of the August contract, just the first 3 days, we've seen 20,126 gold contracts at 100 ounces apiece? That's over 2 million ounces of gold. It works out to almost 7 billion in gold deliveries. Now, one of the things that I really want to hammer home about how significant these numbers are, and they truly are hugely significant, is that every single contract that has been issued has settled for physical metal. This is the real demand, right? So that's a 1-1 ratio. And when you realize that for the past, my whole career, most contracts are closed out before delivery, almost all of them. It's either cash settled or rolled over.
Yep.
These are all standing for delivery, a 1-to-1 ratio. Physical metal is actually changing hands. And as far as I'm concerned, when you see over 2 million ounces of gold stand for delivery, every single contract stand for delivery when they used to say 1% or less stands for delivery. This is the same pattern that we've seen since the beginning of the year, Kevin, since November. If they say gold is now 24,000 an ounce, the U.S. Treasury stands ready to buy any gold that central banks, maybe even they go far as saying individuals. I don't know how far they take it, but the mandate would be we will pay $24,000 an ounce for your gold. No, I think everyone thinks mark to market at 800 or 3,400, which would give about 900 billion to the Treasury.
Right.
But James Rickards and his math says 24,000.
Right.
Other people are saying 15,000. Remember, every $4,000 increase gives the
$1
Treasury 1 trillion. So that if they weaken the dollar, gold goes higher, BRICS win. If the U.S. goes to buy gold to compete, gold goes up, dollar goes down, BRICS win.
Win-win.
But he gets it. But when you have a Treasury Secretary saying we're going to do this, you can expect inflation. There is no way we can pay 37 trillion in debt. Now that's the 28 trillion we owe on the bonds coming due, plus 3 trillion a year equals 9. Over the next 3 years, that's 37 with 15 trillion in tax revenue. You can't do it. And the only way you can bring manufacturing back and make it competitive is devalue the dollar. This is Triffin's dilemma. Here's another crumb.
That doesn't account also for Medicare,
everything.
Social Security.
Everything. Yeah. But here's another crumb. Yeah, the Medicare, Social Security, Medicaid is off balance sheet.
Right.
But here's another crumb, and that other crumb is you have the Vice President of the United States on White House letterhead talking about Triffin's dilemma, saying, it just may not be such a good deal for us anymore to be the world reserve currency. We do not want it. We don't want it. We used to want it. We don't want it now. We don't want it because it will hollow out your manufacturing. That just is what Triffin's dilemma says. The dollar will always be high, and the currencies that have to buy dollars, because we don't give them enough through trade alone, have to sell their currency to buy ours. Their currencies are weak. Ours is high. Manufacturing is way cheaper over there. That's how this problem started. Now, we're too far down the rabbit hole with indebtedness and low interest rates that created distortions in asset prices, where if you raise rates, you blow up this system that has risen to levels that one could argue is not real, that price discovery has been distorted through all of the years of easy money and low interest rates. And so, the house that you live in, what's it worth at 3%? What's it worth at 7%? What's it worth at 10% mortgages, et cetera? They can't allow rates to rise on the back end. That's why you revalue gold, you peg it, redeem it on long end treasuries with zero coupon, and now you have a devalued dollar. If you, like, for example, just so people get that, when Roosevelt confiscated gold in 1933, it was $20. He paid everyone $20.67. Those 67 cents was a lot back then. But then he devalued the dollar by 40%, making gold $35 an ounce. So he devalued the dollar. So if they revalued gold and devalue the dollar and have zero borrowing costs on the long end and the stable coins running the engine on the front end, short end with low rates, you can actually envision bringing back your manufacturing and why is this so important? Because 60% of America is not college educated. What are they going to do when AI comes in and takes all these jobs that are kind of on the low end of the white collar spectrum? What's going to happen? All these people are going to be out of work. So they have to have manufacturing. And the only way that And I can see Trump coming on a Sunday night saying we've messed this up. We all have, and now it's time for us to fix it. And we're going to go through a little bit of pain, but we have to do it for our kids and our grandkids so that we can once again be the engine of innovation and of manufacturing and build our way out of this problem. Because think about it, what do we produce anymore besides IT and financial assets? So the 73,000 on non-farm payrolls was way less than they had expected.
Correct.
But did you see the revision part of that? The revision is the craziest thing I've ever seen. So in May, they told us that we had 144,000 jobs created. And in June, they told us that we had 147,000 jobs created. Well, they just came back after they said that the July non-farm payroll numbers were lower than expected. But sorry, by the way, May, which was 144, we just revised it down to 14. And June, which was 147, well, we just revised that down to 19. So in other words, the 3-month average just fell from 150,000 new jobs to 35. While I would argue to a large degree the banking cartel has really lost the ability to push gold around the way that they'd like to. They're still in control of silver to a degree. But what's different is that in years past, after the drubbing, it would continue to fall. Like through this week, it would be plummeting. They can't do that anymore. There's not enough physical silver to continue to naked short when all of these contracts, what did we just say about the deliveries? All of the contracts that were presented stood for delivery, every single one of them so far. in this delivery cycle, 3 days in, every single one is standing for delivery. That's was an anomaly, but it's kind of becoming
More mainstream. Yeah,
it's becoming not the exception anymore.
It's becoming more the rule, right?
And you cannot naked short something you can't come up with. So I think when you realize the LBMA has 155,000 ounces as their float right now, the lowest ever since they've been keeping records, but they're trading upwards ends throughout the day of 1.9 billion ounces a day, 3.5 times the annual global mine supply. They're doing the same thing with platinum. They're going to get stuck. And I think to a large degree, there are a lot of traders out there that understand this, and they're going to continue to stand for delivery, but in a manner that doesn't trigger that blow up. Maybe there is some form of a coupon. Maybe that coupon is in gold. In other words, maybe they pay you an interest rate in gold as well. So the idea is to have zero borrowing costs on long-term duration Treasury debt when you're going to continue to inflate away your currency. You have to have a yield high enough to make it worth people's while. And so fine, maybe they give you a return in gold, but she wasn't very specific.
No.
While gold remains the traditional store of value, Andy Schectman sees silver as a rare asymmetrical trade, an overlooked asset with massive upside and minimal downside. He highlights that silver is essential across a wide range of industries, yet its price remains artificially suppressed, partly due to its use in small amounts per device. Even a 5-fold increase in silver's price would barely affect end product costs, adding just $80 to a $2,000 computer, for example. This disconnect between industrial importance and market price, Schectman argues, points to deep undervaluation that savvy investors should not ignore. Schectman is not alone in his bullish stance. Keith Neumeyer, a leading voice in the silver mining sector, has forecast that silver could reach $100 per ounce, driven by ongoing supply deficits, soaring industrial demand, and its historic undervaluation relative to gold. Such a move would represent a roughly 175% price increase from current levels, suggesting enormous upside potential. Schectman supports a strategic approach. Accumulate silver when the gold-to-silver ratio is around 100-1 and convert it to gold as the ratio narrows to 50-1 or lower. With silver being mined at a natural ratio of 7-1, today's market imbalance is what he calls ridiculous and fundamentally unsustainable. The gold-to-silver ratio, historically around 15-1 during periods when both metals served as monetary anchors, has hovered between 40-1 and 80-1 in recent decades. Today's reading of 100:1 marks a clear divergence from both historical norms and mining fundamentals. Many market watchers see such extreme levels as a strong contrarian buy signal for silver, suggesting it could dramatically outperform gold when the next monetary or geopolitical shock forces a revaluation of tangible assets. Let's get back to the interview.
The gold standard won't be traditional. It will be backing the Treasury market with gold, not the currency. Currency is going to be destroyed. It'll be backing the bond market with gold in an effort to continue to fund our indebtedness and allow us to reshore manufacturing and grow our way out of it. The old gold standard, where M1, the currency in circulation, was gold or backed by gold, I think those days probably won't come back. It's not practical. Now you got the states here like Florida, who's in essence, and Texas and Oklahoma passing these legal tender laws where in theory you could take American Eagles, go pay your taxes. I don't think they envision people walking around the street with a handful of gold and silver, albeit if the law reads if a shop wants to take your gold and silver, they can. You can't force them to. China's the largest producer of gold in the world, the second largest of silver in the world. All of the countries, it would behoove and benefit them to do exactly that, and to do so in a way that allows them to continue to add. It doesn't affect the price as they're buying it, and it keeps under wraps just how much they own. I think it's 100% happy. I think that right now silver is an opportunity that you don't find ever. I mean, I shouldn't say that because it's here, but it's an opportunity that is very unusual on every level. The word is asymmetrical: lowest downside, highest upside, massive depleting inventories across the globe.
Generational wealth builder.
It is, but I think in the end, the place to be is gold, and that's playing the ratio. You buy silver at 100-1 ratio to gold, and then switch it when it gets to 50, which would still be above its 150-year average, but 7 times higher than it's coming out of the ground at. It's coming out of the ground at 7 to 1. It's priced at 100 to 1. The difference is, you could have $2 million in gold in a big duffel bag. It'd be heavy. It would weigh roughly 600, it would weigh 45, 50 pounds. You could run to your car with it. 2 million in silver is going to weigh probably 3,000 pounds. I'm not kidding. I mean, it's ridiculously heavy. So if you can get past logistics or have it stored, I think silver is a generational opportunity. But gold, when the music stops, is the place to be. If a genie came out of the bottle and said you get one wish, you can buy one, what would it be? I'd probably say gold, just because. And I think in the end, it's going to be part of a new system. If he said you get 2 wishes, the first one would be that you buy a whole bunch of silver, and the second one would be you
swap it for gold. Right. That would be
that's how to do if it all works out according to plan. The amount of silver used in all of this stuff is pittance compared to the price. A Tomahawk cruise missile that uses 500 ounces of silver, sure, it's a lot, but what does a Tomahawk cost? When you talk about industry, because it's used in such small amounts in anything, the amount of silver in this computer is probably amounts to, $20? I don't know. If that. And so if it now it's $100, yeah, your cost went up by $80, but how much is the computer? 2,000? So now it's 2,100. It's not a big deal. It's not a big deal at all. More along the lines, to me, it's not about cost as much as it is if the military industrial complex is the entity behind holding the silver price down, which I believe they are. Why else would you have 8 Western banks holding down the price for so long? The largest concentrated short position in any commodity traded, this tiny little market called silver, it makes 0 sense unless they were doing it for a reason. It's not about holding down the price as much as it is holding down the story. Price is the story. Price allows misdirection of narrative. And if everyone were buying silver, I just saw something on X the other day. If everyone bought 1 ounce of silver in the world, there'd be none left.
Yeah.
So it's more along the lines of saying nothing's to see here, folks. You don't want any of this shit. It's just
keep on moving.
Yes.
Right. Everyone just keep going.
It's not the price as much as it is the decreasing footprint in nature. It's disappearing geologically, and most of what has been used in industry for the last 80 years is in landfills or blown up in bombs. It's gone. It doesn't make sense to recycle 1/5 of an ounce of silver or a tiny little bit out of anything that you would have ever used way back when, like a handheld radio or a hairdryer or any first video game you ever played handheld or any of that stuff has a little bit of silver in it, and it's in a landfill now. So it's gone. So silver is launched. You can do silver. You just can't spend silver right now on your MasterCard.
That's what I meant.
You can only spend gold on the MasterCard. You can accumulate. And then Lavrov comes out and says this new BRICS pay and the BRICS bridge is open to non-BRICS countries except not compatible with the dollar, the pound, or the euro. But they left it at that. And I made a big deal about it, saying, look, this is no small thing. This is 38% of global GDP. Well, Forbes just came out with an article. Let me read this to you. Forbes just pointed out that China is now just the 3rd largest trade partner for the United States, a distant 3rd behind Mexico and Canada. In the month of May, China represented less than 6% of U.S. trade, which is the lowest level in over 20 years. But then it talks about these Asian countries that together have a population twice as large as the United States, over 700 million people. These are also some of the fastest growing consumer markets in the world with a fast growing middle class. And this group of countries is now, get ready for it, China's largest trading partner by far and way ahead of the European Union and the United States. And what are they? Integrated into the bridge payment system that does what? Sidesteps SWIFT clears in 7 seconds and at 98% reduction in fees. And what's coming next? BRICS Pay, which is B2B and consumer to bank, and it's the retail side, which will connect with this too. So now you're talking about a massive portion of the world already that is now the largest trading partner with the Chinese, that's got twice the population of the United States. It's got 40% of global GDP in and of themselves, and that's before the Belt Road and all the other things we talked about. But when you hear that this group has become China's largest trading partner as of May, we only represented 6% of total U.S.-China trade this year. It's the lowest in 20 years, the lowest. Whereas China is trading almost 17% of their foreign trade with the Asian countries. So when you talk about the ability to sidestep SWIFT and it's just no big deal, all these poo-pooers say out there. As you can see, they do things methodically. And by the time this entire infrastructure is set up, now remember, the interesting thing about all of this is that when the BRICS bridge was set up, M-Bridge, there were 4 countries that built it with the BIS Innovation Hub: China, Hong Kong, Thailand, and the United Arab Emirates. But if you all remember from my constant bad beating into your head, who was the 5th main member? Do you remember that too?
I don't know if
You said that very quietly, sheepishly. Are you afraid to?
No, I don't remember.
It was Saudi Arabia. Saudi Arabia became the 5th main member of this bridge technology. And where is the second vault being built? The first one's done in Hong Kong. So if China trades with Saudi Arabia to buy oil and gives them the yuan, right now Saudi Arabia can send that yuan without converting the dollars directly to the Shanghai Metals Exchange in Hong Kong and take possession of physical metal. Where's the second vault being built right now?
Saudi.
In Saudi Arabia. It is under construction. And this is going to be a series of vaults along the Belt Road and throughout this infrastructure. So you have little by little, where did we hear that before? Little by little, we are seeing this infrastructure, the skeletal system be built, and you can see it's becoming more and more and more significant. And in this case, 700 million people, more than twice the US, and the fastest growing consumer markets in the world with the fastest growing middle class, is now going to be able to transact on a central bank to central bank level and on a B2B and consumer to consumer with BRICS Pay outside the SWIFT interface.
Today's financial system is approaching a critical juncture, not just because of excessive debt or monetary mismanagement, but because the very foundations of global finance are starting to fracture. In an era marked by surging deficits, devalued currencies, and escalating geopolitical instability, gold and silver are quietly reemerging as the backbone of absolute monetary trust. As confidence in fiat evaporates and traditional policy tools lose effectiveness, hard assets are no longer optional. They're essential. Silver stands at the heart of this structural transition. Despite its indispensable role in modern technologies and green energy, it remains severely underpriced, held down by decades of financial engineering and supply manipulation. With above-ground inventories shrinking and demand only accelerating, silver is poised for a repricing that could shock even seasoned investors. Gold, meanwhile, continues to function as the anchor of last resort, accumulated by central banks, sovereign funds, and institutions seeking shelter from the fallout of a failing system. The signals are everywhere, from declining confidence in central banks to stealth moves in commodity markets, to rising calls for sound money and asset-backed currencies. Gold and silver are not just responding, they're leading the way. For those who understand the stakes, there's no time for passivity. The shift is accelerating, and precious metals are once again at the center of global value. What if the most excellent wealth transfer of our lifetime is already underway, and most people won't realize it until it's too late? If you found this analysis insightful, be sure to like the video, subscribe to the channel, and share it with others who are seeking clarity in an increasingly chaotic financial world. We'll continue to bring you the voices and perspectives that matter, because this next chapter isn't just economic, it's systemic,